Okay, Assalamu alaikum. Good morning, everyone. Yesterday we were talking about the the causes of capital rationing. Capital rationing means if we limit the supply of capital to a particular sector, that can be called as capital rationing. So what are the reasons for capital rationing? So there are mainly two reasons. The first one is adverse selection, and the second one is moral hazard. So adverse selection happens that in case where there is information asymmetry, and it is very difficult to ascertain which customers are riskier and which customers are less risky. So in this situation, adverse selection may happen. So adverse selection may also happen, say for example, if as a lender, I am supposed to lend to businesses. So it is very difficult to know in advance and ascertain which borrower is going to become a successful businessman and which borrower is going to fail. So if I know in advance which borrower is going to become a successful businessman and which is going to fail, then I will lend money only to the successful borrower. But this does not happen in reality, and it is very difficult to ascertain which customers are safer and which customers are riskier. So this problem is called the problem of adverse selection, which is common both in microfinance and in normal lending business. So adverse selection happens. So that is why the capital is not attracted to this business. So the second reason why why the problem with the lending business, that problem is moral hazard. Moral hazard means it is very difficult to know the intention of the borrower. So intention of the borrower in the adverse selection, the intention may be correct, the intention may be right, but even then a borrower may fail in his business or her business. But in case of moral hazard, the intention of the borrower itself is wrong. The intention of the borrower itself is bad. The borrower is not interested in giving back the principal as well as interest money to the lender. So this problem is called the problem of moral hazard, and it is very difficult for a lender to ascertain which customers are honest and which customers are dishonest. So because of moral hazard also, the capital is normally not attracted to this business. And this happens because of information asymmetry also. Information asymmetry means this information set with the lender is different, and the information which is there with the borrower is different. And this is also related with the bad lemons example of George Akerlof. George Akerlof is an economist who has demonstrated in his paper that if there is a market for anything, and it is very difficult to ascertain the quality of the product in that market. Say for example, there is assume any product, and it is very difficult to ascertain the quality of that product. Then what will happen? Then the market will be flooded with the bad product, because nobody will be interested in manufacturing and selling genuine products. Everybody will start selling bad products, or bad quality products, because customers are not able to differentiate between good and bad. So whether we are selling good quality or bad quality, so the bad quality products will drive out the good quality product from the market. So So this example is known as bad layman's example. So he has given example of layman's, that if customers are not able to differentiate between good layman and bad layman, then the market will be, only filled with bad lemons. Nobody will buy, good lemon, because it is very difficult to ascertain which lemons are good and which lemons are, bad. So the same thing happens in the lending business also, that it is very difficult to ascertain which customers are honest and which customers are dishonest. So if it is difficult for the lender to ascertain the quality of the borrower, in that case only bad borrowers will approach financial institutions, because they will think that the lender is not able to identify us, that we are dishonest and that we will not return that money. So only bad people will line up uh, in front of that microfinance institution for taking loan. So this problem is called the problem of moral hazard. Now coming to to some of the evidence, uh, what evidence shows, what research shows, what researchers have found when they conducted research as far as microfinance is concerned. So the literature confirms that most microfinance programs do not serve the poorest. So in theory, the microfinance is supposed to target the poorest of the poor section of the society. But in reality, studies have found that normally they do not serve the poorest. I mean, the most extreme poor section of the society is not served by the microfinance institution. It is the slightly those people who are slightly better, they take benefit from microfinance institutions. However, there are some institutions that do, and the evidence indicates that the poorest can definitely benefit from microfinance in terms of increased income and reduce vulnerability. This is what the evidence shows. Then there are some, specific studies that have been quoted here. Uh, Kandakar 2001 has found that microfinance participants perform better on per capita income, expenditure, and net worth. So this study was conducted in Bangladesh, because whenever we talk about microfinance, Bangladesh is the best example, because of the Grameen Bank, and because of the large scale implementation of microfinance schemes in Bangladesh. So this study found that the beneficiaries or the participants in the microfinances are performing better on several parameters like per capita income, expenditure. They are spending more, they are earning more, they are spending more, and their net worth is also more. So there is positive impact on their income, expenditure, and net worth. Then another study has found that female credit has positive impact on health of children. So health of children is also positively impacted by microfinance schemes, especially female credit. So if the microfinance institution is targeting female, in that case it is not only impacting that female but also the health of the children. Um, so health of the children, how they measured? They measured health of the children through arm circumference, height for age. This study was also conducted in the context of Bangladesh. Then we have another study that says that income of families with access to finance is significantly higher than for comparable household without access to credit. So if they compared two sets of families, one set of family that has access to credit and another set of family that does not have access to credit, and they found that the families with access to credit, have significantly higher income as compared to those households which don't have access to credit. And then another study says that both saver and saver only account and saver and borrower account families have higher expenditure on food than non-client household. So they compared their expenditure on food, and they found that those who are associated with the microfinance institutions spend more money on food as compared to those who are not the clients of microfinance institutions. Then Majabin has found that microfinance institutions, MFIs, microfinance institutions raise income and consumption level of households, reduce income inequality, and enhance welfare. In Malaysia, we have one microfinance institution that is very large and that has very good, performance. That is Amana Ikhtiyar Malaysia, AIM, Amana Ikhtiyar Malaysia, has positive impact on household income of women borrowers who spent 3 years in the scheme. So in this study, Samir et al., they found that the beneficiaries of Amana Ikhtiyar Malaysia, uh, their income has increased, especially the income of women borrowers has increased. Microcredit may be a more effective remedy against poverty and vulnerability if it is complemented with other interventions like health insurance, food programs, legal education, etc. Grameen Bank members are more likely to use contraceptives. Very interesting finding by Schuler and Hashmi, 1994. That family planning is the clients of Grameen Bank are more likely to do family planning. Hashmi et al. 1994, they found that women's access to credit was associated with an overall reduction in the incidence of domestic violence. This is again very interesting finding that microfinance has also, some relation with domestic violence, that, women that have access to credit um, are less likely to experience incidents of domestic violence. This study is also in the context of Bangladesh, um, by Hashmi et al. Sometimes it keeps land papers, sometimes it keeps, uh, gold, um, or jewelry. So microfinance institution, most microfinance institutions do not keep any collateral. So what is collateral? So if in single statement, collateral is risk management technique by is a risk management tool in the hands of the lender. which is absent as far as microfinance is concerned. In microfinance, there is no collateral. So if there is no collateral, there should be some alternative system. There should be some alternative system that should complement the requirement of the collateral. That should replace the requirement of the collateral. So the focus is on the alternatives of collateral. So what are the alternatives of collateral? So the alternative of collateral is joint liability. So normally the microfinance institution, they lend money to a group of persons, group of women. And if a single person defaults, then they place the liability on the whole group. They place the liability on the whole group. So this concept is known as joint liability. So joint liability is nothing but an alternative to collateral. Collateral is risk management, but in microfinance institutions, they cannot take collateral. So they go for joint liability. They form a group of women in a village, and they say that we will give loan to a single woman, and if she gives back the principal and interest on time, then only we will give loan to another woman, like that. And if any single woman defaults, then they place some kind of penalty on the rest of the members also. For example, the penalty may be limited to not giving loan to those women in future, or maybe recovering money from all of the if the group is five member, then recovering money from the rest of the members. So this concept is known as joint liability. So most of the microfinance, conventional microfinance institutions, they follow the model of joint liability model. The goal is to eliminate moral hazard, adverse selection, and ultimately achieve 100% recovery rate. What is the goal? What is the aim of going for joint liability? The aim is to reduce or eliminate moral hazard, adverse selection. You already do moral hazard. Moral hazard means to eliminate the dishonest borrowers. Adverse selection means to give to only loan to only successful buyers, less risky buyers, safer borrowers, and then achieve 100% recovery rate. So this can be done, this can be achieved using joint liability model also, in that is adopted, that is implemented by the most of the conventional microfinance institutions. So these are some of the models. The first model is by Grameen Bank model. This is known as Grameen Bank model. Then we have Village Bank model. Then Credit Union model, Self-Help Group model, Cooperative Society model. These are some of the models. We will talk about each model one by one. So let us start with Grameen Bank model. Grameen Bank model of microfinance. This was devised by Muhammad Yunus in 1976. A bank was established in 1996 in Bangladesh. So a bank unit is set up with a field manager and a number of bank workers covering an area of about 15 to 12 villages. Field manager visits the village, familiarizes with the local milieu, and explains the purpose and mode of operation of the bank. Initially, a group of 5 prospective borrowers is formed who meet regularly with Grameen Bank field managers. So a group of 5 borrower is formed by the field manager, and they keep meeting regularly. Typically 2 of the 5 prospective borrowers are granted loans if after a probationary time period, typically 50 weeks, The first two borrowers meet the terms of repayment, that is principal plus interest. The remaining members become eligible for a loan. So effectively what is happening here, they are, I mean, in this model, we are taking, advantage of the peer pressure. Peer pressure. So peer pressure acts as a replacement for traditional loan collateral. So if you are forming a group of borrowers, so every borrower will feel peer pressure and shame from the rest of the members of that team, that if he or she will not repay, then what other people will think about her or about him. So this peer pressure works. So no legal instrument and is made between Grameen Bank and its borrowers. The system works based on trust. So there is no legal agreement between the field manager and the borrower. The system is based only on trust and peer pressure. So this is the model that is practiced by the Grameen Bank. um, so this model is based on trust. This model is based on peer pressure. This model is based on joint the concept of joint liability, because a group of five borrower is formed, and whether third borrower will be eligible or not will be decided by the conduct of the initial borrower. If the initial borrower is making repayment on time, then only the third borrower will be eligible. So peer pressure is so because of this recession, this substantial group pressure to keep individual records clear. Grameen became an independent bank in 1983, headquartered in Dhaka, Bangladesh. It has more than 2,200 branches in the country. More than 97% of Grameen's loan recipients have been women. So this is very interesting thing, that most of the Grameen banks loan target only women. 97%. I mean, only 3% borrowers are male. Rest 93% borrowers are women only. And the recovery rate is also exceptionally high. This system is working only on trust. This system is working only on peer pressure. Even in that case, the recovery rate of Grameen Bank is around 98%. 98% recovery rate means only 2%, only 2% default. Only 2% borrowers default. Rest 98%, they make repayment on time. So Grameen's interest on its main credit product is about 20%. So normally, the main product, their main product has 20% rate of interest. So they charge 20% rate of interest from the borrower, and recovery rate is 98%, and 97% of the clients are women. So this is Grameen Bank model. Coming to the next model, that is Village Bank model. Village Bank model has been promoted by Finca. Finca is an organization. Finca is the innovator of the village banking methodology in microcredit, and is widely regarded as one of the pioneers of modern day microfinance. Finca International is a non-profit microfinance organization founded by John Hatch in 1984. So Grameen Bank has evolved in Bangladesh, but this Finca has evolved in developed nations. It has its most of the network of Finca is in developed it initially started in the developed nations. So a village bank is an informal self-help group of 20-30 members, typically female heads of household. Members meet at one of the members' house weekly for working capital requirement, motivation, saving, and skill training. Loans normally starting at $50 to $100 and are linked to savings such that the more a client saves, the more she can borrow. So in this model, what happens? 20 to 30 members team is formed at a village level. So at a village level, 20 to 30 that consists mainly of female heads of households is formed. And this 20 to 30 members, they conduct a weekly meeting at the house of any one of the member for motivation and for working capital requirement and for training. And so the more a member saves, the more that member will be entitled to borrow. So the normal loan period is 4 months and is repaid in 16 weekly installments. 95% clients are female. It relies on a system of cross guarantee, where each member of a village bank ensures the loan of every other female. So every member basically is a guarantor of other person. So 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 basically the Finca International or that organization is giving loan to a single member of that 20 to 30 member group, but so every member is responsible for that amount of loan. So this is known as cross guarantee, because every person, every member of that group is giving guarantee of that borrower. So it relies on a system of cross guarantees where each member of a village bank ensures the loan of every other member. So this system gives rise to an atmosphere of social pressure within the village bank, where the cost of social embarrassment motivates bank members to repay their loans in full. So because of social pressure and embarrassment, every member and every borrower that borrows from the microfinance institutions feels social embarrassment and pressure to repay that amount of loan. This method has proven very effective for Finca, yielding a repayment rate of over 97% in its worldwide network. So the recovery rate of Finca model is around 97%. So just because of in this Finca model, the main thing is social pressure. The group is very large and cross guarantee is there. And the common thing in Grameen bank model and village bank model is female clients that they mainly target female heads of the family, and they normally pick and this, in some studies they have found also that the recovery rate of females is better than the recovery rate of males. So for them also, for female clients, female customers are better prospects, a better borrower. That is why in most of the microfinance institutions, normally they target female borrowers. So village banks are highly democratic, self-managed grassroots organizations. They elect their own leaders, select their own members. So this member of 20 or 30 groups, this is a democratic setup in which they select their own leader, they select their own members, create their own bylaws, do their own bookkeeping, manage all funds, disperse and deposit all funds, resolve loan delinquency problems, and levy their own fines on members who come late, miss meetings, or fall behind in their payments. So all these rules and operational rules are designed by this committee, that is the committee of 20 to 30 female members. And the financing is done by the FINCA. The financing is done by MFI. So the MFI just gives money to this committee of 20 to 30 members, and they self-govern, they self-decide, they design their own rules uh, for members and for their leaders, for the rules for what will happen if somebody defaults, things like that. So village banks depend for their financing capital on MFIs. So this 20 to 30 member committee is known as village bank. Village bank. And as far as financing is concerned, financing and capital is supplied by the MFIs, microfinance institutions, either directly or through local NGOs. Sometimes microfinance institutions directly supply the fund to that committee, and sometimes they supply through a mediator, local NGO. So capital, if supplied by the MFIs on timely payment of installments, guaranteed jointly by the members of the village bank. So joint liability concept is there, that because every member is jointly responsible for the payment of installments. Average portfolio yield of 71 microfinance institutions engaged in village banking was 27.7 in 2006, lower than local money lenders. So the rate of interest charged by village bank model is around 27.7%. But the local money lenders, they charge even more than this, that is 27.7%. You might notice here that even in Grameen bank model, their average rate of interest is 20%. And in village banking model, their interest rate is around 27.7%. If we compare this rate with the normal interest rate from a normal bank, so that is around 12% or 13%. So this is just double, just double, the interest charged by the microfinance institution is just double the interest charged by the normal banks. So this is one of the criticism of microfinance institutions also, that microfinance institutions target the poorest section of the society, but they are charging a very high rate of interest from them. But again, since the cost of serving the poorest is very high, the cost associated with this microfinance institution is very high, because the cost of distribution, the cost of monitoring, the cost of maintaining offices at different remote villages. So a lot of costs are involved. So that is why the rate of interest charged by microfinance institutions is normally higher than the normal loan. Okay, that was for today. We will continue tomorrow also. Uh, we will talk about the rest of the models. Then we will come to the Islamic microfinance model, because you might have observed that in Grameen bank model also and in village bank model also, the rate of interest is very high, and both are interest based model. But interest in Islamic microfinance model, we have to just convert the Grameen bank model and village bank model in such a manner that interest is not there. So if we just remove the interest part, then that microfinance model can be termed as Islamic microfinance model. Okay, thank you very much for joining this class. Thank you very much. If there is any question, any observation, you can make. Okay, thank you very much. Now I'm
Thank you,
signing
sir.
off.